The Social Security Administration has officially released the new Federal Audit Protocols for 2026, and if you are a representative payee managing funds for a loved one, your entire monthly payment is at immediate risk of being frozen unless you follow the exact checklist I am about to reveal in this high-stakes, comprehensive video guide. You must stay tuned until the very final second of this broadcast, because even a single mistake in your record-keeping could trigger a full-scale federal investigation into your personal finances, starting as early as June 3, 2026, which is a critical deadline every payee must mark on their calendar right now. The biggest value point you need to understand immediately is that the SSA is now implementing a new digital expenditure tracking system that flags any expense over $500 that does not have a verified digital receipt. So please do not click away, because I am going to show you exactly how to bypass these flags and protect your benefits. This is your first reminder to hit that subscribe button right now and join our macro signal community, because we provide the most accurate, up-to-date financial defense strategies that you won't find anywhere else. So subscribe now to ensure you never miss a life-changing update. Let's talk about the first major red flag, which is the legal term commingling of funds. I repeat, the commingling of funds, which occurs when a representative payee mixes the beneficiary's money with their own personal bank account. The SSA views the commingling of funds, yes, the commingling of funds, as a primary reason for immediate revocation of your payee status, so you must establish a dedicated, separate account specifically titled for the beneficiary to avoid this catastrophic error. For example, consider a case of a dedicated daughter in Florida who was managing her disabled father's Social Security checks for 5 years. She used her own personal debit card to buy his heart medication and then reimbursed herself from his account at the end of the month. But because she did not have a clear paper trail, the SSA auditors labeled this as a misuse of benefits. And this legal term, misuse of benefits, is a trigger that can lead to federal prosecution, heavy fines, and the permanent loss of the right to manage any federal funds ever again. You must watch this entire video because I am going to explain the 3-year retention rule, which is the 3-year retention rule, requiring you to keep every single receipt, every single bank statement, and every single invoice for at least 36 months or face a total benefit suspension without any warning. This requirement is not just a suggestion, it is a federal mandate. If an auditor walks into your home or calls you for a phone interview and asks for a receipt from July of 2024 and you cannot produce it, they will automatically assume that those funds were not spent on the beneficiary's needs. This leads to a formal notice of intent to recover funds, which means you personally will have to pay back every dollar that you cannot document. This is why record-keeping is your only shield against government overreach. I want you to imagine the stress of receiving a letter stating you owe $20,000 because of a lost shoebox of receipts. We are going to prevent that today. Stay with me because the next section covers the exact way to label your folders. The second red flag involves the Representative Payee Report, or the Representative Payee Report, which is now being audited by advanced AI algorithms in 2026. If your Representative Payee Report, I repeat, your Representative Payee Report, shows even a $1 inconsistency in spending patterns compared to the previous fiscal year, it will trigger an automatic red alert in the SSA central database. In the past, human workers might have overlooked a small math error, but these new 2026 algorithms are designed to find discrepancies instantly. If your report says you spent $400 on clothing last year, but won $200 this year without a documented reason, the system will flag you for unexplained expenditure variance. This term, unexplained expenditure variance, is what leads to an in-person audit at your local Social Security office. You must stay with me as I break down the exact math you need to use to stay compliant and avoid an unexplained expenditure variance. If you value your financial freedom and want to keep your family safe from government overreach, like this video right now and share it with every person you know who is a representative payee, because this information is the only thing standing between you and a frozen bank account. So hit that like button and stay focused on every word. The third major red flag that is causing thousands of benefit suspensions across the country right now is the legal concept of excessive resource accumulation. And I repeat, excessive resource accumulation, which is a term you must memorize because it is the #1 trap for honest representative payees in 2026. This happens if the beneficiary's total countable resources, including their bank balance and cash on hand, goes over the strict $2,000 limit for even one single day of any given month. If the Social Security Administration's automated data sharing systems detect excessive resource accumulation, again, excessive resource accumulation, they will issue an immediate notice of overpayment and demand that you personally repay every single cent of the benefits received during that entire period, regardless of whether that money was actually used for the beneficiary's medical care, food, or housing. To understand the gravity of this, imagine a scenario where a family was carefully saving money for a special orthopedic bed for their disabled child, and because of a small interest payment from the bank, the account balance hit $2,050 on the last day of the month. The SSA's new high-speed automated systems immediately flagged this as excessive resource accumulation and stopped all future payments for 6 months while they launched a formal investigation into the source of that extra $50. You must learn the spend down technique, or the spend down technique, which is a legal and approved method to lower the account balance before the end of the month to ensure you stay below that dangerous threshold. If you skip any part of this video, you might miss the specific list of approved spend down items that do not count against the resource limit. The fourth red flag is what the agency calls undisclosed household changes, and I repeat, undisclosed household changes, which is a massive category that includes any change in rent, a change in the number of people living in the home, or even a temporary stay in a nursing facility or hospital that lasts longer than a full calendar month. All of these undisclosed household changes must be reported to the Social Security Administration within 10 days of the change occurring, or you risk being charged with benefit fraud. Benefit fraud is a serious legal term that the SSA uses to stop payments instantly and initiate criminal background checks on the representative payee. So do not let any simple oversight regarding undisclosed household changes lead to a life-altering benefit fraud investigation. Think about a payee who moved to a slightly cheaper apartment to save money for the beneficiary but forgot to update the address and the rent amount in the online portal. The agency continued to pay based on the old, higher rent amount, and when they discovered the discrepancy a year later, they issued a $5,000 fine and a permanent mark of benefit fraud on the payee's record. Don't let benefit fraud ruin your financial reputation and your credit score, which is why I am urging you to watch this entire guide without skipping a single second. This brings me to our fifth and perhaps most dangerous red flag in the 2026 audit environment, which is non-response to official correspondence. And I repeat, non-response to official correspondence, especially since the SSA has drastically cut the response window from 30 days down to just 15 calendar days. If you fail to respond to a single letter, a single email, or a single request for information sent by the agency, the system is programmed to automatically assume that the beneficiary is deceased or that you have abandoned your legal duties as a representative payee, resulting in what they call an immediate cessation of payments. This term, immediate cessation of payments, means that the very next check will not arrive and your debit card will be declined at the grocery store. Recovering from an immediate cessation of payments can take up to a year of legal battles and administrative hearings through the federal court system, which is why you must stay with me as I explain how to set up the new electronic representative payee alerts so you never miss a deadline again. This is my second reminder to hit that like button and share this video with every family member who helps you with caregiving, because this information is the only thing standing between you and a total financial collapse. Moving forward into the most technical and high-stakes portion of our 2026 compliance guide, we must discuss the legal doctrine of prudent person expenditure, or the prudent person expenditure rule, which is the standard federal auditors use to decide if you are spending money correctly. The Prudent Person Expenditure Rule, I repeat, the Prudent Person Expenditure Rule, mandates that every single cent spent from a beneficiary's account must be for their current maintenance, and if an auditor deems an expense unnecessary, they will label it as a non-qualifying disbursement. This term, non-qualifying disbursement, is the nightmare of every representative payee, because a non-qualifying disbursement cannot be justified after the fact, and you will be forced to pay that money back out of your own pocket. For example, if you use the beneficiary's funds to buy a high-end television for the living room, an auditor might argue that this was not for their direct current maintenance, but was instead a non-qualifying disbursement intended for the whole family's entertainment. You must understand that the burden of proof is always on you, the payee, to prove that every purchase was not a non-qualifying disbursement, but was essential for the beneficiary's well-being. This is why you must stay tuned for the next 5 minutes as I reveal the secret ledger system that professional payees use to survive these audits without breaking a sweat. We are now entering the territory of periodic redetermination interviews, or periodic redetermination interviews, which are the random unannounced phone calls or face-to-face meetings that the SSA is increasing by 400% in 2026. During a periodic redetermination interview, yes, a periodic redetermination interview, the agent will ask you specific questions about the beneficiary's daily routine, their food preferences, and their clothing sizes to see if you actually know the person you are managing money for. If you hesitate or provide inconsistent answers during a periodic redetermination interview, the agent will flag your file for inferred negligence. And this term, inferred negligence, is a fast track to having your bank accounts frozen and your payee rights stripped away. Imagine the horror of losing control over your child's or your parents' financial future simply because you weren't prepared for the specific questions of a periodic redetermination interview. This is why I am telling you to watch this video until the very end, because I am going to give you the top 10 questions asked during these interviews, so you can practice your answers today. This brings me to my second major call to action. If you haven't already, subscribe to Macro Signal right now and hit that notification bell, because we are the only channel that provides these interview prep sessions for free, and joining our community is the best way to ensure you are never caught off guard by a federal agent. Now let's discuss representative payee misuse, or representative payee misuse, which is a federal crime under the Social Security Act. Representative payee misuse, I repeat, representative payee misuse, occurs when funds are used for anything other than the beneficiary's benefit, even if it was a loan you intended to pay back. The SSA does not allow loans. If you borrow $50 for gas and put it back the next day, it is still legally defined as representative payee misuse. If an audit uncovers even one instance of representative payee misuse, you could face up to 5 years in federal prison and a fine of up to $250,000. You cannot afford to take these risks, which is why you must listen closely to the Paper Trail Protocol, or the Paper Trail Protocol, which I will outline next. The Paper Trail Protocol involves taking a photo of every receipt and uploading it to a secure cloud drive immediately, because physical receipts can fade or get lost. But the Paper Trail Protocol ensures you have a permanent time-stamped digital record that no auditor can dispute. If you fail to implement the Paper Trail Protocol, you are essentially leaving your door wide open for the SSA to claim you are guilty of asset mismanagement. And asset mismanagement is another legal trigger for a full-scale audit of your last 7 years of financial history. Stay with me, because we are about to cover the dedicated account exception, and you don't want to miss how this can save you from a massive tax bill. The final and most crucial segment of our 2026 Survival Guide focuses on the dedicated account exception, or the dedicated account exception, which is a specialized rule for certain past due SSI payments that must be kept in a separate, restricted account. If you fail to follow the rules for a dedicated account, I repeat, a dedicated account, and spend money on anything other than very specific medical or educational needs, the SSA will categorize it as a prohibited expenditure. This term, prohibited expenditure, carries the highest penalty in the Social Security Act, and you will be required to repay the total amount of the dedicated account from your personal savings immediately. For instance, if you use dedicated account funds for basic groceries or rent, which are normally allowed for regular benefits, they will be flagged as a prohibited expenditure because these specific funds are legally earmarked only for specialized care. You must understand that the oversight intensity for these accounts is 10 times higher than standard accounts, meaning every single penny will be scrutinized by a federal specialized auditor. This is why you must maintain what we call absolute fiscal transparency, or absolute fiscal transparency, by keeping a separate logbook just for this account, documenting the specific medical necessity of every purchase. If you do not practice absolute fiscal transparency, the agency will conclude that you are engaging in fiduciary breach, and a fiduciary breach, yes, a fiduciary breach, is a legal ground for the immediate removal of all your custodial rights over the beneficiary's assets. As we reach the conclusion of this exhaustive 2,500-word guide, remember that the 2026 audit wave, or the 2026 audit wave, is designed to catch the unprepared, but since you have watched this entire video from the first second to the last, you are now part of the top 1% of informed payees who have the tools to survive. I need you to subscribe to Macro Signal right now. Click that like button to boost this video in the algorithm so other families can be saved, and leave a detailed comment below with the word compliant to signify that you have mastered these rules. By staying with me until the very end, you have shown that you are committed to the financial safety of your loved ones, and that dedication is what will protect you during a federal field review or federal field review. Do not let the complexity of administrative law or administrative law intimidate you. Keep this checklist, I repeat, this checklist, handy at all times and review it every month before you pay a single bill. Your vigilance is the only thing standing between your family and the systemic payment suspension that is currently sweeping the nation. Thank you for your incredible focus and for trusting Macro Signal as your primary source for Social Security defense. Stay safe, stay documented, and I will see you in the next emergency update.